Here we go, right on time, live at 5 Thursday. Let's see, so it's June 29th before a long weekend, and I don't know about you guys, but I'm like totally exhausted from this week. And having said that, we have a very special guest today, and I'm super excited to have a real discussion with Dan Clifton, who knows all about policy. And it's candidly, Dan, I haven't told you this, but I don't know that everybody fully understands, and we'll touch on this in a bit, the impacts of policy, right?
Yep, that's right.
So it's an interesting, it's going to be a really interesting, powerful discussion. I mean, shoot, we're, everybody remembers policy when the debt ceiling's,
Exactly.
a question mark, but it's an ongoing thing, and I'm really looking forward to having a discussion around it. So anybody who doesn't know me, I'm Dan Weiskopf, the ETF professor and also co-portfolio manager of Block, as well as lead ETF strategist for the ETF Think Tank, and also on the investment committee at Title Financial Group. That's a long-winded saying that I'm busy. So with that, I'm going to hand it off to Cynthia, and Cynthia, you take it away and keep it going.
Yeah, but by comparison, I sound a lot less busy. I'm Cynthia Murphy, head of research, full stop. Thanks everybody for coming. We love our Thursday shows. We love when you guys join us. We have a phenomenal guest today. We're super excited. He's with the Strategas group. We'll let him introduce himself in a minute. David, why don't you take it away and then pass it to our guest?
Thanks so much. David Chikansky here, fellow portfolio manager in the Title Financial Group, and very excited, as Cynthia mentioned, to have Dan Clifton with us of Strategas, and we're going to talk about how to really apply things that are occurring in the policy markets to investments, which I'm super excited about. So Dan, why don't you jump in, introduce yourself and your firm, and we'll go from there.
Great. First, it's an honor to be here. Huge fan. And thank you for having me. I'm Dan Clifton, head of policy research at Strategas Securities. We provide research to institutional investors. It's not just policy, it's investment strategy, economics, technical, fixed income. And then what we try and do is overlay how those verticals come together into a comprehensive investment strategy for our institutional clients. Additionally, we run two ETFs. The Strategas Global Policy portfolio is what I run, which is exactly what we're going to talk about today, not the fund itself, but trying to find underpriced earnings of companies based on policy and be able to invest in those. And as Dan mentioned right at the start of the show, is that it's not just about the debt ceiling or a big fight. It's continuous. It just keeps coming at you, and there's always issues to be looking at. We'll talk about how we do that. We've been doing it since 2007, but we also have a broader practice where we build thematic policy portfolios for just about any type of issue that's out there. So, hey, we're not going to pass cannabis. How do we play it? We figured that out. How do we get better returns on clean energy than the clean energy ETFs that are out there? Those are the types of things that we're trying to do. And we run about 15 of those policy thematic baskets as well. Again, great honor to be here. I'm looking forward to the conversation, and thank you everybody for joining us today.
So I'm going to go first and start off. I do remember us meeting back in 2007, 2008, which was a lot of fun. I'm glad you brought the colorful tie without a spot this time.
That's right. That's right.
Where I was going was, tell us about who your clients are. I think you guys are a little bit of a secret in the RIA space, and I just want to highlight what you bring to the table.
Sure. So first, let me start off by saying that our clients are the broad swath of institutional investors. That could be the large mutual funds, that could be private equity firms, that could be state and local pension funds, it could be endowments, it could be hedge funds. And then you obviously have this growing field of the wealth management registered investment advisor community, which is taking a much greater importance. When I got into business in 2007, 2008, the biggest clients were BlackRock, Wellington, Fidelity, Capital Group, and they're still very big and important clients, but you just see a different level of different types of institutional investors, a much more diversified field of those institutional clients. What we're generally doing is providing research and doing in-person meetings for our institutional clients. And today, now that we have so much on the RIA side as well, we do a lot of events for our clients' in walking through, what policy implications are going to be. So next year will be a big year for that. It's a presidential election year, and we'll talk about the race and how to monitor race and policy implications are, and then how that feeds through to financial markets.
And before I hand it off to David, you do have ETFs. Maybe highlight a little bit about those ETFs, and then we'll shoot over to David with the tough questions.
Yeah, sure. So, by the way, if these are the questions, these are great questions. So I want to enjoy some drinks here. But the first thing I would say is that we launched 2 ETFs in January of 2022, the beginning of a pretty big bear market, and so we ended up having a pretty good year in 2022. My fund, the one that I run, is called the Strategas Global Policy Opportunities Portfolio. Its ticker is SAGP. This is based on our long-standing thesis that the market cannot price the earnings impact from policy developments in Washington. It is a quantitative fund where we use quantitative analysis based on what each company is lobbying on, how much they're spending lobbying on, and then have some denominator inputs there from the balance sheet itself. And then we rank and then we score. We have historically run that as a large cap fund, US large cap fund. But what we started to realize is that there was a greater earnings inefficiency among small and mid-sized companies and non-US companies that lobby in the US. So we built a multi-class fund, which includes large cap, small and mid cap, and non-US. And in 2022, we were fortunate that all 3 of those buckets outperformed the benchmark, which is the ACWI, All Country World Index. And we've given back some of those relative gains over time, but we're still way ahead of the benchmark 16 months in. So this has been a good stress test, launching it in such difficult markets. And then my partners launched what's called the Strategas Macro Thematic Fund, SAMT, and that is designed to create continuous cycle of macro themes. So a lot of the ETF business, as you probably know well, Dan, picks a theme and then just sticks with it. And those themes aren't going to work all the time. And so we try and capture many of the themes that are current right now and be able to rotate in and out of those themes over time. And they run somewhere between 3 and 5 themes. Currently, AI is one, recession protection is another. So they have a couple of themes there for this year. And it's really based on what our research is producing. We're very research driven. And it's also based on our knowledge of just what's important from our clients and how we see the environment itself. So SAMT, SAGP, I wouldn't be surprised if there's future launches that deal with some of the other research verticals that we have at Strategas as well. But that's still a little bit of time off.
Cool. David, you're up.
Yeah, and just Dan mentioned it and he put it in the chat, but the drinking word is policy. So cheers, everyone.
There you
Dan, I have a 2-part question, both on like the international side and like just some outlines on what is like a change in policy. Is it like physical, like boots on the ground? Is it like drinks purchased for a government official? Like what are the secret sauce of like the numbers? You're like, oh, I saw that delta change, and now this stock is on my radar. Like, and on the other side, on the international side, a name that popped up to me in my mind was Shopify. If you could highlight that, and just clarification. It looks like this is basically like 2-tiered equal weight, and then you just rebalance to that. Is that fair?
It's fair. So let me just start off for how we found this. In 2008, Bear Stearns went down, and our research thesis was that Washington was going to have a greater impact over financial markets moving forward. And we tested a whole bunch of political variables on stock performance, and they all failed. So what we started to do was test on baskets of stocks, and boy, did we hit the money shot. 50 large cap stocks, back test works beautifully. It always works in the back test. It never works in real life. So we were cautious about it. And it was 50 stocks equally weighted. Why do you equally weight it? Well, you don't know when the earnings benefit's going to hit, right? For one company, it could be 1 month. One company, it could be 4 months from now. And so you just kind of want to keep them equally weighted. I know that doesn't sound very imaginative, but it's worked out really well. And then, 2008 was not a good time to be testing portfolios, given the financial crisis that we were in. But by the time that we got to March of 2009, it was very clear to us that there was going to be some real pitchforks coming out for causing the financial crisis. And so, hey, we got a basket on lobbying, and hey, our thesis is that this is protection for these companies when the pitchfork comes out. And we got the strategy right, we got the thesis totally wrong. And what we started to see was that companies that were in our basket in 2009 also outperformed in 2010 and 2011. So you're talking about 50 S&P 500 companies outperforming 3 consecutive years in a row while active management was suffering. And that's when we realized that there's this kind of earnings benefit that accrues from those companies. So in terms of how we structure that, we're really trying to get to quarterly lobbying. As a lobbyist myself in my previous life, I had to fill out these forms and I hated it. And I had to put down everything that I was working on. And we go through those. We just finished the All Country World Index, which is like 2,000 companies and everything that they're lobbying on for the second quarter. We finished that this morning. So we have a good understanding of what every company is working on.
Was that before? Was that before or after your cup of coffee?
Yeah, exactly. Exactly. So, but it takes a while to go through all those lobbying reports. And so what we're trying to do is really capture that intensity. We have companies in there like, pick a smaller company. They spend $200,000 on lobbying, very different than an Amazon, which is going to spend 15 million on lobbying. But yet we don't really own Amazon. We very rarely ever own Amazon. And that's because Amazon or a big company has to lobby on a lot of issues that don't have earnings benefits. So they're worried about worker safety and labor, and that's all important, but it's not generating an earnings benefit. And that's why as you get smaller down the cap scale, the earnings benefit gets larger. And that's why it's really worked on the small and mid cap size for us since we launched that in 2018, and why we included it in the fund itself. So we update every quarter, we equally weight. Usually you see 4 or 5 names coming in each quarter per vertical. But we celebrate that turnover, David, and we celebrate it because we know the portfolio is rotating as the political environment changes. When Obama won, while we were testing the portfolio, we had 15 names come in and 15 names come out in the first quarter of Obama. And we didn't know what to make of that. We were like, whoa, I'm not sure that we can even run this as a strategy. And today we celebrate it. Those were the Bush names coming out. Those were the Obama names coming in. The healthcare stocks traded like they were going to go out of business. And then we went on a 6-year bull run in healthcare stock, which generated a lot of alpha. So when we see heavy turnover, that's the continuous super cycle that we call in this. We never really have to get out of the strategy. It's constantly rotating. It's probably more information than you wanted.
No, but so is this kind of strategy, like, is it turnover really high in terms of portfolio? Because like I was reading your outlook and it talks about in terms of a policy environment, this is the craziest it's been in like 40 years, I think you said, or something like that. So from that perspective, with the landscape that is changing so much and so rapidly, does that mean, I don't even understand how you would sort the opportunities, and are they super short-term opportunities, or do they have some legs?
No, most of them have legs. So what we know is that the longer a company is in the fund, the better it outperforms. So there's been 12 companies that have been in the large cap fund since 2010, and they have outperformed the S&P 500 by 5% annually when you group those together over that time, right? And so then as you go down, you say, okay, which ones have been in there for the last 8 years, 6 years, 5 years? That alpha comes down. And what that's telling you is that if you have a long-term government affairs program, you are building in that protection. You are figuring out how the game is played. It doesn't matter who wins or loses. What you're referencing, Cynthia, which I think is a great point, is that we're going through a once in 40-year transformation in the 3 major macro areas. So number one is monetary policy. Obviously, we have to get inflation out for the first time since 1982. Second is fiscal policy. What's it like when you have a rising debt servicing cost? We can't cut taxes and increase spending the way we used to. But third, which I think is the most important, is that geopolitics are changing. So these companies have built these amazing supply chains for efficiency over the last 40 years. that model no longer works. And so if you're a semiconductor company, you're going to get whacked here because you're not going to be able to sell into your largest market. So you got to figure out a way around it. And that's why you're seeing the CHIPS Act and how do you bring that manufacturing home? How do you bring it out? What we're saying is it's proper corporate governance of a company to now be engaged in the lobbying process so that they can understand if their business model is going to change based on public policy reaction. So it's more important for them to be involved in the process today because the changes are going to be much larger than we've been used to since the Berlin Wall came down in 1989. This is a multipolar world. China is challenging the US. The US has been somewhat slow to respond, but they are now responding forcefully. And interestingly, I believe it's going to wind up unifying the United States. We look at what's going on TV, the Republicans and Democrats fighting, we're weaponizing politics against each other. And yet there's so much level of agreement between the Republicans and Democrats on how to respond to China. And it will be the biggest issue over the next 5 years.
So
Dan,
before, Dan, can I just follow real quick? Sorry. So is it fair to understand this as the companies that are most proactive about engaging with the policy discussion actually provide a level of downside protection, if you will?
Absolutely. Yep. And look, our large cap fund was down last year. We were down 5%. I'll take it. Okay. And for most of the time, it had what's called positive upside capture and negative downside capture. So we were doing better in the up years and the down years. That's a little bit less so in the large cap fund today. But that's why we refined it for the ETF. We now have a smaller, more concentrated level of names than what we historically ran in the large cap fund.
so I have two questions. One's an easy question, one's a hard one. The easy question for you to answer is, and I'm going to ask them, together, so you can choose which one you want to answer, because I know everybody wants to ask you questions, and I just want to get this off my chest. China, you mentioned China. Are you investing in China right now, or are you holding back? Then the other question that's totally separate. So I'm involved in the Bitcoin Mining Council.
Yeah.
And we are setting up to do some lobbying.
Yes.
In Washington. You have to do it, right?
Yes.
How does one measure the trajectory in a lobbying effort? Because let's be honest, it doesn't happen overnight.
Absolutely.
So those are my two questions.
So first, let me handle the China one. Right now, we have no investments in China. If a Chinese company quantitatively triggered into our portfolio, we would invest in it, right? I take human emotion out of this. And I just want to be clear here. In May of 2017, our formula triggered that we had to sell Amazon, which we had only held for 2 quarters, and buy Best Buy and Gap. There's no human being on earth that would have made that trade subjectively at the height of the death of retail, right? But what was happening was that the lobbying reports were telling us that Best Buy and Gap were worried about something called the border adjustable tax that Trump was proposing, and they wanted a corporate tax rate cut. And that's far more significant for them than anything that Amazon was doing. And so Amazon fell below our threshold. They came in, we made the trade, we had a lot of hand holding, and worked out really well. Like those stocks were up 40% from May to the end of the year. Amazon was up 30 from that point, right? So everybody did well. We did a little bit better. And we were like, okay, that's great. You've got to trust the process. It's really hard to invest in a Chinese company right now. They have a very slow recovery. They have a bad economy. And the key issue is that the Western companies are leaving there so fast for any production they're doing for outside China. That's why the leadership of China is bringing in Elon Musk, Jamie Dimon, Bill Gates. They're doing a charm offensive. We actually think they're going to tone down their rhetoric about Taiwan because that's why Western companies are leaving. Like, this is fascinating stuff that's going on, right? So we're constantly monitoring it. And we're seeing some of these Chinese companies slowly rising in our lobbying score every quarter, slowly lobbying because they've been locked out of this market. They're trying to figure out how to get in that market. So if we're presented with that opportunity, we don't really have a choice based on our mandate. Now, my compliance department will give me a really hard time about it, just because There's so much paperwork and restrictions to invest in it. But ultimately, we would do that. So that's number one. Number two, Bitcoin Mining Council. Let's look at what's going on. David, I don't think I answered your question about the company that you asked about, right?
No,
and right, what's that?
No, fine. Answer his question. It's much more interesting.
It's all related, but like Shopify is lobbying on digital assets right now. And they're lobbying on credit card transactions right now. So it's a Canadian company that believes that they have to be in the US lobbying on this. We have a digital assets bill that's moving through the House Financial Services Committee right now. There's probably going to be provisions that are going to impact you maybe in that bill, or at least, but you've got to do it over time. Lobbying is one of the most honest professions there is in the world today. I know that's contrarian and most people don't agree. When I worked in government, the best information I got was from lobbyists, and the good lobbyists will walk in and they'll tell me, here's what we're advocating for. Here's why we think it's good for this area, the country, the state, the town, okay? And here's who's going to be against it. And here's what they're going to argue, so that I'm not getting my boss involved in landmines that they don't want to step into, right? And so when it's done well, it's extremely honest, and it builds a level of trust. And that trust takes years and years to develop, and that honesty. So the sooner you start, the better. Now I can look at your council and see which companies are in there, and I can get you to a quantitatively reasonable amount of money that we think that you should be doing, and what activities you should be doing, because not everybody spends money very well. Google is a really inefficient spender of lobbying dollars, which is amazing. They're terrible at it, okay? And that's why they can be a big company and under attack all the time, because they're not using it the right way. The other side of it is that Meta, Facebook, is really good at lobbying and know how to spend their dollars very well. So it's part of a strategy. You got to have leadership there. You got to have people who know how to do this. And if you do, it becomes a very good risk management technique, but even a better technique for advancing how you would like to see the world operate, so to speak, and what would be good for the country.
I love it. You look at lobbyist dollars as like an ROI investment, and you basically look for like quality lobbyist spending, right? So
yep. Right.
Is it both quality of the lobbyist spending and a little bit of the delta, as Dan said, like, hey, these stocks get on my radar because they're quarter over quarter spending delta changed, and then you like assess the quality?
Yeah, we know who the good ones are. And you know, like we're sending a letter right now to the top lobbyists, congratulating them on the great job that they're doing. So we have a list of them that we keep, and of course that list changes over time, and it's just like any other industry. But lobbying dollars is the main driver of what goes on. If I just did aggregate lobbying spend, I would have the Dow 30 and some tobacco companies. So you really need to capture the intensity of that lobbying spend, and that's why the delta is so important.
Awesome.
What's a bare minimum spend?
If you think of a lobbying to earnings impact Hall of Fame on the stocks you follow all these years, who stands out as the biggest surprise to the upside in terms of, you know, earnings impact, and the biggest loser in that space?
Awesome question. So this is not meant to be a stock recommendation. This is a pure lobbying analysis of things that have happened in the past. I just want to qualify my statement for that. The biggest winners that we've seen since we've run the fund is Eli Lilly. Eli Lilly is doing amazing stuff right now on Alzheimer's, on diabetes, on weight loss. And, you know, you get a simple change of a 9-year exclusivity on the Medicare drug price reimbursement, move that to 13. It really moves the needle for them at some point in the future, right? So like that's just a broad change. And but they're in the Hall of Fame. Edward Life Science on the device side, probably, I mean, just an incredible company that's the leader. And when they got into our lobbying basket, they were like a second tier device company at that time underneath the bigger names. So those are two in healthcare. And I'll just say this, that biotech has the greatest return on investment, and healthcare has the best relative returns to their sector. So the companies in our basket relative to the sector, healthcare is the dominant one. So you'll often hear me talk about healthcare companies itself. In technology, you're going to get very moaty companies. So you're going to get Intuit, right? Intuit is TurboTax. They're trying to protect their moat. MasterCard was a long time, 10, 11-year winner in that place, trying to protect them. By the way, Shopify lobbying on that as well, right? So you asked me about a company, I'm going to integrate it in onto some of these issues, but they're very worried about their interchange fees today. Meta is another good example. As soon as they were eligible, they went in 2012, and that's why we could do this with like IPOs when IPOs launch. And if companies are lobbying, it's usually a good sign that that company is building to be a much larger company. And so you could track these IPOs over time and get them, and then they eventually get into the larger indexes and get that outperformance. I'll give you another moat one in technology, VeriSign, which does the internet hosting. It's a volatile stock, but their returns over a long period of time have been good. In the industrial sector, which is another big weight of ours, defense, Lockheed Martin, Northrop Grumman, really big long-term winners. I know that sounds boring, but man, check out their last 10, 12-year performance. They're very, very good in that respect. We get some material companies. I don't think there's been any like Hall of Fame hits from that. I would argue Altria. Altria, up until recently, was a master capital allocator in the consumer staples. So it cuts across all industries, and you can identify these companies that are going to be in there year after year, and their compounded returns have been far superior to market returns.
So I guess clean energy's done well, right?
Yep.
In the context of a lobbyist, or just in general, getting the right policy implanted, right?
Yep.
Talk to us a little bit about clean energy.
Yep. So, by the way, it's an emerging industry in the lobbying world today. They didn't even have trade associations, very disparate. You have wind, solar, EVs. You now have something called the American Clean Power Association, which was designed to create a trade association of all the clean energy companies. They have a very outsized impact in the Biden administration. So, hey, we're going to do a traditional infrastructure bill. Oh, we got to check with the American Clean Power Association because does it have climate impacts to it? Whole of government approach. And so what we did at Strategas, a little bit different than what we're talking about with the ETF, is that I have a colleague, her name is Courtney Rosenberger. She's the best, and I'm biased, but she's the best thematic portfolio builder, basket builder on policy on Wall Street. And she basically went into the lobbying of the clean energy companies and built out a universe, and then said we should get better returns on that. And so what we use is we use the iShares Clean Energy Index, ICLN, I think it is, and we use that as our benchmark. And if we're doing our job right, we should get a better return over that. And what's interesting is that when we started this, probably ahead of Biden's election, knowing that he was, if he wins, this is going to be a big priority. What we're starting to see is the companies that were in that basket are now starting to get into our broader lobbying names. You could see them rising up because the rules are being written. And this is where it gets really important. How do you structure the green hydrogen rules? How do you structure the EV tax credits and the battery building? Do you go outside the US? Do you do it here? I know this sounds really wonky, but they have major financial impacts for these companies. And let me tell you one other takeaway that we have is that we're seeing companies that weren't involved in clean energy now getting involved in this, because whenever the government gives out money, by the way, this offends me when I say it, but whenever the government gives out money, there's a line for that money. And so you're seeing Chevron lobbying for things in the clean energy space. You're seeing carbon capture get a lot of attention, which was in the Inflation Reduction Act. And you're just seeing this kind of movement, this rotation, because now I get this big pot of money that passed last year. But I got to tell you, I covered that bill. I've covered every major fiscal bill for 20 years. And and nobody really understood what was being passed at that time. Now that the money's there and the rules are written, people are like, oh, I want to get in this. And so we're seeing a lot of traditional, what I would say, non-clean energy companies saying, how do I get a piece of that pie? And it's changing the lobbying. Lobbying with Dan, just to give you context, lobbying was flat for 10 years in the S&P 500, flat, same dollar amounts. And we are now going through a renaissance, 12% last year, another 10% halfway through the year this year. This is a big change. And I think it's because of what Cynthia asked about before, this kind of changing rotation, these big macro 40-year transformations happening, but also Biden's spending a lot of money.
Awesome. So two quick things is one is, have you ever looked at like the junk lobby spending as like a short? Because it sounds like you guys are pretty accurate with that as well. And then secondly, you have an impressively low allocation to the Super 7 stocks, right? We were talking about like tax credits on EV. Like, I don't think I see Tesla in your portfolio. So, you know, I think in today's day and age, especially in like the lobbying space, that's something that I was like most surprised to see in your basket is just the lack of like Super 7 overlap, which is impressive. And so like, talk about that. And has that always been the case? Has that rolled off at some points or was higher at some points? But like, where are they in their lobbying efforts? You talked a little bit about Alphabet, but what about the rest of the Super 7? So.
Yeah, so awesome question, by the way. So look, we underperformed in 2018 on the large cap side because we didn't have exposure to a lot of these names. Like, it's just a fact of the reality. But we did it without major exposure to those names. So Amazon has been in, it's sporadic. It really hasn't been in for the last couple of years. Google is not in. I don't anticipate that they're ever going to get in. Based on where they are. In fact, they could change their ways now that they're being forced to cut costs and maybe do this more efficiently, but they're just all over the place. Facebook Meta was a large time holding. We held it for 10 years. And what we're seeing now is some of that intensity has come down. I think they need it more than ever, but they have just exited our large cap side. So we've always really had exposure to Meta up until recently. Netflix at the early stages, we owned it in 2011, 2012, and 2013. It was amazing to own. We haven't really owned it since then, right? So those are the big four. No Microsoft, which is 5. No NVIDIA. AMD was a long time holding. We no longer hold that. If I was looking for somewhere where there's active on the semiconductor space, it's Qualcomm. It's a little bit different. Qualcomm is very politically active in the United States. And as soon as they were challenged on their deal, they had Republicans and Democrats, coming out and supporting them. They've really shown how to do that game. So I'll tell you what, I mean, it's going to hurt not having access to those companies at times. Like now, we were able to manage through it. Now we think we're going into a cycle where you get less liquidity. When you get less liquidity, those names are probably not going to do as strong as they thought. Well, when I say that, my institutional clients like want to cut my head off because they love the story and the story is great. But, we gave a lot of liquidity in the fourth quarter of 1999. And those stocks went up for 9 more weeks and then it was over. And we gave a lot of liquidity throughout the financial crisis and throughout COVID. And when it reverses, it usually moves you away from long duration stocks to more shorter duration stocks. And I think our position is, our portfolio is positioned for that type of liquidity change that's coming.
So I'm glad to see Eric Connolly is coming up for the question very soon. Eric, you're up next. I just want to ask a quick question. We've talked about the winners, but I don't expect you'd be long marijuana, but what did they do so badly from a lobbyist perspective? I mean, it's just
yeah. By the way, I mean, our view was that the Safe Banking Act would never pass. And, as you know, there was a very spirited debate at the end of the year to get that into an omnibus, and they failed repeatedly. By the way, they're getting much, much better at lobbying, right? So it's like machine learning. Like, you fail one year, you fail another year, you fail another year. Eventually, you're going to get it, and they're getting closer. So I would anticipate that there will be an effort to put Safe Banking Act on an end of the year spending bill this year. So we'll go through it again. And they've made a little bit of progress. They have a different speaker now, speaker from California, which is located near some of the areas where they grow marijuana. So maybe a little bit more open. Mitch McConnell may have a little bit less leverage to kill the Safe Banking Act as he's done in the past. But think about our process, right? Our process is, do we think this is going to pass? Probably not. And my colleague Courtney went through the lobbying of every company on cannabis. And her results were amazing because she figured out that there were companies lobbying on licensing at the state dispensary level. And right. And like Scott's Miracle. There were just all these different companies that were lobbying on it, that we said to ourselves, can we build a basket that isn't dependent on the Safe Banking Act passing, but could benefit from the trend to more of this cannabis? And we put that out in March of 2019, and we still run the basket. We really haven't changed that much. And by the way, it hasn't done great on an absolute basis, but it has crushed the marijuana ETFs. I mean, crushed it. And it's preserved capital rather than killed capital. And that's just the way that we think about it. And the reason why I'm going in detail about cannabis is it's a very policy-driven sector. So that's why that's an area where we can have an edge in trying to understand who those winners and losers are. There are no cannabis names, no digital currency names, and at this point, very few green energy names at this that are in our traditional basket still at this point. Green energy is getting close. Digital cannabis, you know, I'm not sure they're going to be in this year, but digital assets is still way below, and that's something that needs. And just one other point on it: the incumbents are now lobbying on digital assets. Those are the non-digital asset companies, right? And that's the key: is you never let you never let the challenger come in. Now the incumbents are going to set the rules, and they're going to wind up taking share in that space.
It's not really fair. But okay, so Eric Connolly has two questions, and
Excellent.
I must warn you, Eric always has some really good questions that are tough. Right. He's in an airport, so I'm going to ask the question. Okay, the first one: how do you count for trade group contributions and dark pool dollars?
So dark pool dollars are a little bit less important to us because they're going to be more contribution side. Contributions really, flow contributions really are not a factor in stock performance. And so we've stayed away from that. What trade association provides a real challenge for us, because if I'm a health insurer and I want to go up against Obamacare, I don't want to put my name on that, United Health, because I'm trying to preserve my brand and I don't want to make an enemy. So I'm going to give my money to a trade association to block that money. And we worried about it for a long period of time. And it was probably an over worry on our point because what we started to learn when we began to get some trade associations disclose how much they spend, or companies are now disclosing what they spend to the trade association, which some activist shareholders are requiring. And it's almost proportional based on the limited analysis that we have of that. And so it really hasn't hurt us, so to speak. We may have missed a few, we may have probably overestimated a few, but overall, in terms of performance, it really hasn't hurt us. It remains a big challenge. The other challenge for us, which is going to be a little bit different than trade associations, is that companies now are engaging more in PR firms and less in lobbying. So they're basically saying to, you know, Cynthia PR firm, go lay down the groundwork ahead of our lobbying effort, which I would consider lobbying dollars, and they don't have to disclose that type of spend. And so we may be missing a little bit on that front as well. So Eric, again, great question. You're exposing some of the deficiencies in our strategy. I mean, overall, it hasn't hurt performance, nor do we see anything really out of line based on the limited data we have, but it's definitely a challenge.
So this shift, real quick, this shift to using PR as a path to that, is that to circumvent detection and reporting, or is it some kind of evolution of the lobbying?
It's an evolution because we're in a world where people live in their own little ideological sphere, and you're trying to get a message out. So I walk in there and I'm like, hey, I'm here on behalf of the Bitcoin Mining Council, and I got this issue. And I'm starting the education process from scratch. Now, if the Bitcoin Mining Council, which I'm just using as an example, is able to get that in the New York Times ahead of time, they can walk in and, oh, I read that article. That was in my clips the other day. Oh my God, we're really losing all these jobs to China, you know, whatever the issue is going to be. Or, you know, you get it in some more specialized publication on the right or left. If you're dealing with a more ideological member, you're laying down the groundwork before you get there. And it's almost like you got 50% of your work done. So I think it's more of an evolution, but it presents a challenge to us because we think it's vital to the process, and it's just not being disclosed.
So Ray, you want to ask your question and I'll come back with Eric's?
Yep. Thanks,
Hi,
David.
Ray.
A couple questions. Actually, I'm just kind of wondering on the international ex-US side of this. One question is as far as like the effective versus the non-effective in the United States for companies that are located outside. And then more of a general question, how does all this work? And it's probably different everywhere. I guess maybe in democracies outside of the US, how does this whole lobbying process work or influence process work? Thanks.
Well, awesome question. So first, what we're trying to measure are non-US companies that lobby in Washington, D.C. That's what we're trying to capture. If you look at the Inflation Reduction Act, there were a lot of provisions in there that blocked out non-US companies from being able to participate. And there was a whole, diplomatic row, and Macron's upset in France, and we have to go change our trade laws now to go fix it so that Japan and South Korea and Australia and the UK and EU are included in that. And those are the types of things that we're trying to pick up, is that when our companies that we're tracking are lobbying here, they're already ahead of the game relative to their peers in their country. And so we think there's a distinct advantage here. We think it's more important today than it's ever been, or at least in modern times, because most countries are going to America first or pick your country first, and they're going to favor their own domestic development, their own domestic companies. So it's incumbent upon those companies to say, here's what we have, and here's how we can benefit your goals. Yes, we're a non-US company, but we have headquarters in Norwalk, Connecticut, and this is how we're doing it, whatever that's going to be. I got to tell you, there's a lot of zeros on that spreadsheet of non-US companies lobbying in Washington, so much so that it's painful to do, because I just ate up 4 hours putting zeros in a spreadsheet for these companies. But we think that that's where the real edge is. Like, who else is going to sit there and do that? We do it, and it spits out what we need to in terms of the quantitative numbers. Your broader question, which I think is an amazing question, is something that's been more challenging to us. We now have EU lobbying data. EU lobbying is not the same as the United States, and it's much more insular, it's much more tougher, and they are now releasing lobbying spend. And we were like, oh, this is great. We're going to build a European lobbying basket. This is amazing. And we're going to have it for every country or every region. And it's harder to get. It's probably not as robust. It's more about what you're working on than how much you're working on. And it's just a much more difficult process itself. And the lobbying process is probably not going to produce the same type of results. So I'm not sure it's really applicable, at least in terms of the experimenting that we've done. We'll continue to try and make it work, because it would be really cool if we could figure it out. We just haven't been able to figure it out yet.
Thanks.
I think we're all quite impressed in your ability to decipher like the quality of policy. The one thing that you mentioned about like 5 minutes ago, and then we talked about before the call, is the other factor that's going to drive the returns here, which is like the Federal Reserve. So if we could, can we turn this conversation a little bit to your thoughts on the Fed balance sheet, the TPG? I know you guys as a firm do a lot of work in this space, and it relates to how you make your investments in this space as well. So if you could just maybe paint your framework picture for where we are in the balance sheet, and if you want to give us all the billion-dollar question of like, where is it going in 12 to 18 months? So.
Awesome question. So first, let me say my bias is that I believe that stimulus matters for equity markets and for bond markets. My clients who are bottom-up stock pickers tell me I might overestimate the impact that this has, and that's true. There's definitely fundamental factors, but there's also macro factors. That's why I work at a macro firm. And since 2009, since we started a quantitative easing period, there's been a very strong correlation between the price to earnings ratio on the S&P 500 and the level of what we call liquidity in the system. Liquidity is the Fed balance sheet, the TGA, which is the Treasury General Account, and reverse repos. Those last two, the Treasury General Account, reverse repos, are relatively new concepts that started in 2020 and late 2021. So really, it's the Fed balance sheet that was the main driver of that, and that makes sense. The Fed is basically lowering interest rates, changing the discount that you're going to put on earnings, and it changes the allocation that we want to buy in stocks when they're in QE period. What happened is that in 2020, the Treasury Department made a decision that they were going to fill up what's called the Treasury General Account. This is a fund that usually held less than $1 billion, maybe $5 billion at most. And what they did in that fund is that they basically built it to about 450 billion. And so they said, okay, when we get to an emergency, we'll have this fund to spend so we don't have to go to the bond market. And that emergency would be like 2008, 2020, and that they'll have that. Well, it had some unintended consequences because when we hit the debt ceiling, the Treasury can no longer issue net new debt. And they said, oh, well, we got this wonderful Treasury General Account that we could spend down. So the Treasury, since January 19th, was basically spending $600 billion out of this fund without raising debt or raising taxes, and it was offsetting the Federal Reserve's quantitative tightening. Imagine on January 19th, if the Fed chairman stood up, did a press conference and said, I'm canceling QT from now until June 2nd. The market would have went bananas. And the 7 or 8 big large cap tech stocks would have went totally crazy. Okay. But we just did it through a back door. And the reason why I bring that up to you is we learned in 2021 that when we raised the debt ceiling, we had this massive rally in stocks. And 17 days after the debt ceiling was raised and Biden went to market and started issuing debt, the S&P rolled over. The NASDAQ began to underperform the S&P 500. You began to see this rotation in stocks. And so, again, we learned from that. We learned that this stuff really matters. And that relationship between net liquidity and the S&P, or net liquidity and NASDAQ relative to the S&P, or the dollar, or, Dan, don't get mad at me, Bitcoin. Bitcoin fits perfect with our net liquidity index, okay? Like it's amazing how all this stuff was just working. So we just went through a debt ceiling. We just raised the debt ceiling. And our view was that once the debt ceiling gets raised, you'll start to see more risk into the equity market, and particularly around a sector rotation away from the high-flying tech, more into industrials. And by the way, that the rotation into industrials is happening. But man, the tech stuff just doesn't stop, man. It's relentless, and it's probably going to go on for a little bit here. But we are draining so much liquidity. We've done 250 billion in the last 2 weeks. And what will happen is that money will start to come out of bank deposits to fund the debt, and then it will ultimately come out of bank reserves. And as it goes out of bank reserves, that's where you'll start to see the equity market response. Now, what we do is we try and match up all these indicators with liquidity. And one that did not work was something called gold. And that was a surprise. What we found is that gold is a leading indicator of liquidity, and gold is telling you where things are headed. So gold led the markets on inflation on the way up. Gold led the markets on inflation on the way down. And gold is telling us that liquidity is going to come down until November. And once we get to November, we're probably going to see a big shoot up of liquidity. And that makes sense to us. The economy is probably going to start slowing here. Employment's going to start slowing here. The Fed's going to be under pressure to start relaxing some of its QT. And boy, does Joe Biden want to get reelected. And they're going to have 600 billion in their TGA. There, right? And you're going to see this pump get primed. And I think actual liquidity is going to be higher in 18 months from where we are right now. But you have to go through this lower period, probably for the next 3 or 4 months before you begin to see it reverse.
I unfortunately completely agree. And we wrote in our last commentary that, like, QT is something that's like often spoken about, but never actually like realized, right? It's just like this myth that doesn't actually occur. But, in an inflationary cycle where inflation is supply driven, not debt, not caused by like debt, QT is what slows down that kind of inflation. It's a little bit terrifying. But so you're saying we'll be closer to 9 trillion, 10 trillion. You think we're actually on our way back up like in the next like 18 months instead of like?
Well, yeah, we're at 6 trillion on liquidity now. We'll probably be at 5.5 before we start going, probably 5.2 trillion, and then we'll start going up again. And you know, it's like watching that TV show, the 70s show, because policymakers are saying, I don't want to repeat the 70s, and they're going to do that. Hank Paulson didn't want to repeat Japan during the financial crisis, and then we repeated Japan, right? So they'll do it. And if you look at what happened in the 70s, it was a big roller coaster. You had inflation, policy got really tight, inflation came down. I think inflation is coming down fast. And then the Fed gets worried about the economy. They take their foot off the accelerator and on the inflation stopping, and then boom, it reaccelerates back up. And so this is, once the genie's out of the bottle on inflation, it's very hard to put back in, and it's very painful to rein it in. And I'm not sure we have the political threshold for that. So, you know, that's just the way I think about it. I can't give you an exact number, but I can map it out for you once I run the numbers. But I'm not sure 9 trillion, but maybe 7.5. Big number.
So Lily Poi has a question. Lily, do you want to ask the question? You want me to?
Oh, can you hear me?
Yep.
Oh, okay. Oh boy. Yes, I didn't hear you say anything about the defense industry because I know they're a big lobbying group. So can you tell us a little bit? Thank you.
Lily, thank you for your question. We briefly mentioned it earlier. I should have expanded more on it. So thank you for asking this. The defense industry are very good at what they do, and they're very good lobbyists. I often joke I don't mess with people with guns or money, private equity or defense, because they always figure out a way to win. Let's look at where we are today. We had a big run up in defense stocks in 2022. They were positive when the equity market was down 20%. So you're looking at almost like a 30 or 40% return. We got to early January, and you had 2 big events going on, one macro and one specific. The macro, which you're going to say, what does that have to do with defense, is that investors started getting bullish on the China reopening. And when that happened, you saw a flight out of what I call domestic stocks towards more multinational stocks. And that rotation started to flow out of defense. And then on January 6th, I was at my desk at about noon. I walked over to the refrigerator, got a water, came back to my desk, literally 2 minutes. And the defense stocks were down 5% in that 2-minute period. There was a headline that crossed that the Republicans were going to cut defense spending as a position of the debt ceiling. And so basically, equity market investors just basically took the stocks down, took the multiple down on those stocks and said, hey, wake me up when this thing is over. I'm going to reassess these down the road. So they've been pretty poor investments for the year. Last year, the defense industry got a 9.5% increase in spending, 9.5. Okay. And they got that through with a Democratic president and a Democratic Congress. And the idea was, hey, we'll do 9.5% for 1 year. The Republicans have just won in the House. They're going to cut government spending. So really the best way to think about it is they're going to get 9.5% over 2 years rather than 1 year. And that's important context because we just passed the debt ceiling bill and the defense industry didn't get zeroed out. They got 3.5%. So you're talking about a 13% increase for the defense industry over 2 years. And the stocks have not moved since the debt ceiling deal. The reason for that is that we still have to go through the appropriations process for the remainder of this year. There's a chance we're going to have a government shutdown. There's a chance that we're going to have what's called sequestration, which is going to reduce spending. And so the range of outcome on defense spending right now is either 3.5% or -1. And that's a pretty big delta for the industry. And a lot of investors have been unwilling to put their feet in the water. My sense is that their lobbying will produce the same result that they had last year. And that is that they're going to survive with a 2 or 3% increase. And I do expect that the stocks will rally when we get to that data point. That data point is going to happen either September 30th, December 30th, or March 30th. And my sense is it will probably be closer to December 30th than the other 2 dates. So I hope I'm answering your question on that, Lily.
Didn't Lockheed Martin just start signing like a lot of big contracts with like European countries because of like some bill that just got passed? That wasn't actually my question. That was just a random thought. But so I don't know if there's any fancier guide to the markets from JP Morgan, but they used to have this amazing chart that showed basically like if Democrats were bullish, like we were in a bull market. If Republicans were bullish, we're in a bull market. When they're both bearish, we're in a bear market. So what I want to ask you is like, is the turnover in your portfolio tied to like a significant amount of turnover tied to, at least in the constituents, not in the rebalance, to like a change of the House, the Senate, and the presidency? Like, are those just like where you get the majority of your turnover periods in like a 4-year cycle? Or is it also like inter-period, or how much is it?
Awesome question. So our whole thesis is based on that question. Our whole thesis, and that is that the companies understand their risks and opportunities faster than investors do. And so but by the way, we outperformed under Republican, Democrat, mixed government. We're going through the biggest change. We've changed political parties 8 of 9 last elections. We have not had this level of turnover since Reconstruction post-Civil War. Okay, so very, very rare event. And what's happening is our companies continue to do well in this environment, even though we keep switching parties every 2 years, right? So that means that there's a level of sustainability and adjustability to the companies that are in the portfolio. Has it worked as well as it has in the past in the large cap space? I would say no. The large cap space is our best year of performance is year 1 of a presidential cycle, because that's when you get the most policy change and the least amount of consensus understanding of what that policy change could be. And that's sort of leveled out a little bit in our large cap space. And we're obviously just experimenting with the non-US, but we're seeing it in our small cap, that we now have 5 years of history with. So, but that's like a major part of our thesis, is that the CEO of company X understands that opportunity and risk faster than the investor does. Our formula picks that up. We get in before that happens. And that's the Best Buy Gap story I told you before. We often ask about losers, right? I haven't answered any questions about losers, even though you've asked 3 times. I'm sorry, I just got carried away with the other hand. Gilead Science was a major, is the biggest loser. They cured hepatitis C in 2013. They cured it. The system is not built for cures. They cured it. Can you imagine waking up one day as a lobbyist and the company CEO says, Dan, we've cured hepatitis C. Oh my God, I get to go to Washington and tell everybody I just saved Medicare $1 trillion in kidney and liver transplants? You know what they forgot to do, David? They forgot to go to Washington and tell people what they did. And you know what? Somebody had to pay for those drugs, and it was $80,000. And the hospitals didn't like it, the state governments didn't like it, the managed care companies didn't like it, and they went nuts and they lost. Okay, Gilead will never make that mistake again. Bill Gates made that mistake in 1999, right? He was like, oh, I'm making software. Well, Larry Ellison at Oracle was like, I'm going to put antitrust on you. Okay, so immediately Microsoft built a major government relations team in 1999. It's not as effective anymore, and that's why they're struggling with Activision. But you see how this game works. And so, we own a company called Vertex in our large cap strategy, and they do cystic fibrosis. Their drug's $250,000. It's 3 times the cost of Gilead. It affects a much smaller portion of the population. But they are making little kids and older Americans productive with cystic fibrosis, and they're going to make sure everybody in America knows what they're doing to make people's lives better. And I think that's effective in terms of their strategy, and that's the way it should be carried out.
Sorry, Dan wants to close this out because we are rounding up, but I have one last quick question. So you seem very interested in who the actual lobbyist is. Like, it feels like you look at them as like a talented coach. Do you ever see like a bad CEO who hires a new talented coach and you're like, I'm betting on this team now, they hired this like star coach? Like, is that essentially how it works? Or
you do? First, let me say, new CEOs can look for cost cutting and impact their government relations. New CEOs could understand the power of government, power of lobbying, and then upgrade it. So it's a special situation, if that's the correct way to term it. And we monitor it. We have 3 different daily newsletters on the lobbying industry that we get every day. Who's going where, who's going there, blah, blah, blah. And, you know, a lot of it is just noise, but you usually could see big star changes and, you know, from one firm to another, or what I call a hire for gun, like you hire a hired gun who has 5 clients, goes in-house at a firm. That's a huge deal when those changes happen. And say, oh, you know, company X is now bringing in this person. Those are important changes because we know they're going to come in and they're going to measure for resources. One final point, I know we're running up on time, is that a good lobbyist could understand when they're going to lose and be able to then adjust it within the company. NASDAQ losing on market structure to New York Stock Exchange, realizing it midstream, changing their business model, and then being able to take advantage of NMS. It's probably one of the greatest lobbying stories I've ever seen, and really led to the emergence of NASDAQ being a true competitor to the New York Stock Exchange, for better or worse. But they were on the verge of losing, and they realized it, and they changed. Like any good investor who is in a bad trade and can realize that and is able to get out. So sorry for that long-winded story.
No, it's interesting you say it. So NASDAQ, New York Stock Exchange, sounds like structure matters. I had to throw that in there. So Dan, thank you so much for the time. You know, I think I started the morning watching you on CNBC. Now I'm concluding the day with you, and this has been supremely helpful. Can people subscribe to your research, or it's only for institutions?
It's institutions. If you're at a registered investment advisor, we may have an agreement with the larger firm itself. But check us out, strategasrp.com and Strategas Asset Management. You can check us out. Always contact me, and if we could work together, that would be great.
And of course, you can look at the ETFs.
ETFs, yep, that's right.
Cynthia, anything left?
I think we covered it all, and this was one of the most fascinating conversations we've had in a while. So thank you so much, Dan. Lots to digest here. It was great.
It's an honor to be here. Thank you for having me. And Dan, I think your day is going to be better tomorrow when you wake up without me and you end your day without me. So
well, we grilled you. We really grilled you. Thanks, everybody. Thank you so much, everybody, for being part of the tank. And
happy 4th of July.
Happy 4th of July.
Yep.
Thanks, Cynthia. That's
See
great.
you all next time.
Talk to you soon.